if you look at that reopening trade that we've been talking about in the past year, there's still a part of the economy that's shut off. Like, so, for example, I think you put it out recently yourself on social media. You're going to go to a in-person live event, right? There are companies that are listed that are about live events, and we know that we can't do that right now. But the reopening is I think going to happen fully in the sense that as the vaccinations completely roll out, businesses like live events and entertainment will really see a revival. So I think that part has not been priced in. Of course, the big index is up quite a bit, and it's a lot about technology and stay at home. Maybe there's some leveling off now. You can see that in those major indices. As interest rates are going to rise, that's going to maybe put a bit damper on the big index. But in the reopening, there's a lot of opportunities still left.
Yeah, and where are those opportunities, Ben? And we got some good news, by the way, on vaccine supplies. I posted it to my Twitter account last night at Sully CNBC that maybe we're going to see this huge surge in vaccinations coming, which is, fingers crossed, sort of good news for everybody here and around the world. But are you looking at cruise lines? Are you looking at a stadium, Madison Square Garden, wrestling? Is it the stuff where you're literally jammed on top of each other? Is that what you're talking about? Is maybe the last to come back?
Yeah, exactly. That's exactly the last that has to come back still. And look at those particular stocks, and I'm not the analyst on it, but just as an example, they are down still about 20-25% from a year ago, whereas a lot of other, let's say, major airlines, hotels are up more, anticipating this reopening. So I think that part of the economy, what was shut off, which is still difficult to do at this moment, could have a revival. Because as you said, the vaccine is really impacting already the economy, and it's going to be seeing a massive rollout. Take the example of the UK now overnight. The services PMI came out hugely strong, and the UK has made a huge advancement in the rollout of its vaccine. So you can see there how that impacts that side of the economy quickly, same as in Israel. So I think in the United States, the same thing. And what's then left? Well, yeah, anything that we couldn't do for a year will probably have a lot of opportunity. So the names that you mentioned will have upside from here.
Yeah, and what about the yield curve, and more particularly 10-year Treasury yields? There's been a lot of talk about how yields might be predicting inflation, or something that could be, to your job title, a global macro risk. Do rapidly rising, well, at least for the bond market anyway, Ben, do rapidly rising yields concern you about equities?
Indeed, if they rapidly rise, and I think that's the distinction to make. At the moment, we're sitting at 1.3 on the 10-year. That is actually the low that we had in 2019, 16, and 12 when we had a crisis then. So it is a resistance level. I think if you really break through that with a major boost to say that we're going to go from 1.3 to 2% in a short order, then probably the equity market will not trade well. But at the same time, as the yield curve has steepened, as inflation expectations have picked up, nominal yields should rise too. The 10-year should move higher from here because the economy is already at a 4% or higher growth, probably a bit stronger even in the second quarter. So as long as that's orderly, I think the stock market will not react too negatively to it. And I think also noted that the real interest rate has now moved from -1% to say -0.85%, is a sign of that the bond market has accepted that the economy will normalize, it will grow faster. So that is, I think, still positive for the equity markets. If it's too rapid, then it could be friction.
Shepard Smith here. Thanks for watching CNBC on YouTube.